Howdy folks, this is Josh Taylor and I want to take you through today this very short video, a quick Q&A on a couple of questions that we had from some of our customers. And so let's open one of these charts here. This is going to be a very quick video today. I'm going to show you a little bit how one of the questions that we had is over the last few days. We've gotten in a lot of very profitable trades over the last week. I think it's 8 or 9 profitable trades. And a couple of the trade signals that we sent out, by the time this particular customer opened up his email and put the trade signals into his software, the trade had already moved. So I want to show you on this Euro USD chart of how to basically handle those trades. So I'm gonna kind of zoom this in here a little bit. Okay, so you see here, like we've been riding this channel. The Euro USD has been riding in this channel for over the last week, and we've been buying, selling, all the way through. Now it finally broke into a new channel, but this customer missed an opportunity here, somewhere in here, to buy or sell this pair. I can't remember the exact details in the email, but let's run through a scenario so we can show you exactly how we do this. Now let's just see here that this line it's right above 1.3100, but let's just say we said to buy. Let me think here for a second on how we should put this together. Let's say that we said to sell the euro here. Let's do that. Let's take a sell position. This is used for an example. Okay, let's say that we sent out a signal that said to sell the euro at 1.3200. Now, according to this chart, that wouldn't have been a great trade. So, but we're just using this for an example. So let's say we said to sell the euro US dollar at 1.3200. Our profit target was 1.3100, and let's say our stop was 1.3400. So the stop would have been way up in here. Okay. The problem is this customer, by the time he logged into his software, the price had already moved up to 1.3220. Okay, so when you try to enter a limit order to sell at 1.3200, it won't take. And the reason is because the currency pair is already moved higher than 1.3200. So here's what I'm going to suggest on how to manage that trade. As long as the trade is still in play, when we send these trade signals out, now we got lucky here. It pretty much held right on the line, a little bit past the line of 1.3200, and when we sold. But sometimes this thing may shoot 100 pips up, like it's moved 100 pips almost since then. So if we set a trade signal out to you to sell at 1.3200, and by the time you open your software to enter the trade, it's already at 1.3250. It's up here. Then go ahead and do an entry sell at market. Okay, you would sell at market. The reason being, our goal is to see that if that's the trade that we are taking, which in this case we are not selling short the euro right now. Okay, until I can see what this thing's going to do. But if that was the case, then reality is the higher this thing goes for a sell position, the less risk you have between where your entry and your stop, so you don't have to risk as much capital. Plus, you have a further drop down, so you're talking about more profitable. So the reality is, if you would have sold at 1.3200 as opposed to selling at 1.3250, the 1.3250 would actually be a better entry point because it's deeper in the money. Do you get what I'm saying? Now, based on these charts, selling the euro right there is not a good idea. But the reality is, I think this is overbought, and I think it's going to drop down anyway. But I hope that makes sense to you. So if you get a trade signal, because sometimes it moves fast, we'll send out a signal to, like we said, we'll send out a signal to sell at 1.3200. But by the time the market moves so fast that by the time you open your email, it's already moved. Okay, if that's the case, you continue with your profit target, you continue with your stop loss up here, but you just buy at market instead of a sell limit. Okay, because you're buying deeper into the money. Okay, does that make sense? And the second question we had is from another customer, and we're going to show you on the same example, is, when we're trading in a range, what happens, how do we protect ourselves from being stopped out when the market breaks out of the range? Okay, and let me show you an example on what happened here on the Aussie dollar. Let me see if I can pull this up. Okay, now this is just a simple chart, but we actually sold, where did we sell? Right in here on this Australian dollar US dollar pair at 1.7050. Okay, just make that green so we can see it. This is where we sold, and we expected at this point that once price had moved to this area, that we expected that price was going to drop because this was an old support line. You could see, a resistance point. You can see that price drove for, let's see, a period of almost a month. And as soon as it hit this 1.0750, it totally rejected it and it bombed. So we were expecting the same. Now it broke through a little bit. So if we zoom this in, we wanted to sell here, and we were expecting the profit target to be here, and I don't have the numbers in front of me. Oh yeah. And then 1.0850, we had our stop loss here. Okay, so here's what we did. Okay, you can see this is a mini range, okay, for a few days, and we were expecting this thing to drop down here. You can see that this was rejecting, and it blew past. So the way to get out of a trade once it breaks into a new range is when we sold here with a stop here and a profit target here, once this thing started going up, and we saw that this thing could honestly continue taking off, we knew that it was going to reject for a little bit. So what we did is we changed our limit, which is where we want to take our profit, to our open. So what happened is we almost got stopped out here. As price moved its way down today, it closed out our trade at break even. So we didn't lose, but we didn't win. But our number one thing, remember I told you, and I think I told you in the webinar before, something that Will Rogers said, which was he's not as concerned on his return on investment as he is on the return of investment. Okay, so the reality is that in this case, rather than just stay in the trade and potentially get stopped out, we'd rather get out at break even so that we protect our downside. Yes, it's great making money, but the key way to keep that money is to make sure that we minimize our losses as much as possible. So when this thing broke out of the range, because our stop loss was high enough and we didn't get stopped out, what we did is we changed the trade to make our profit, our target, to close the trade at our open rate so that at least it closed at 0. Alright, now if this thing comes back down to a different range, we'll start trading this pair again, but I hope that makes sense. So anyway, if you have any more questions, send an email to Ticket to support, and we'd be glad to help you in any way we can.